All right. Okay, so we know what corporations are, right? And we know that you need to incorporate through a state. And then it's the state that authorizes you to issue stock. We talked about what are some of the benefits of corporations. I don't think I need to review all of that to you. The fact that corporations are heavily regulated, though, that is an important concept. We looked at, Danny, make sure you put your name on the list. We looked at the pros and cons of issuing debt versus equity, right? Sometimes companies need to raise money in order to expand in some way, and so they could borrow money through bonds or loans, or they could issue stock, right? Those are the two basic options. There are pros and cons to both. So corporations typically do both. And then just to refresh your memory, if you use debt financing, there's no direct impact on equity. And if you use equity financing, there's no direct impact on your liabilities. We know the difference between publicly traded corporations and privately held corporations, right? When corporations are traded publicly and their stock is being sold over a stock exchange, that is called the secondary market. So who remembers what is the primary market? Secondary market is buying stock over a stock exchange. What is the primary market? Primary would be before secondary, right? Because it means first. So if you're buying stock directly from a company, that's the primary market. But again, only accredited investors can do that. So most investors buy their stock on the secondary market through a stock exchange. All right, so we learned there's common stock and there's preferred stock. What are the advantages to common stock over preferred stock? Not everybody at once. So, do preferred shareholders get to vote? No, but common stockholders do. So, in terms of who's on the board of directors and anything else that's put before the stockholders for a vote, if you own common stock, you get one vote for every share. And if you own preferred stock, you don't get to vote. Who's more likely to get dividends? Preferred stockholders or common stockholders? Preferred. Exactly. When the dividends are paid out, the preferred stockholders get the first right to those dividends. And only after that obligation has been met do the stockholders get any dividends, if there's any money left over. Now, that doesn't necessarily mean that the preferred stockholders get more dividends. It just means they're more likely to get dividends. So, I'm not going to go through it, but again, we learned there are different shares of stock. Common stockholders sometimes have a preemptive right. So those are some of the main benefits of common stock. Because common stock is less likely to get dividends, the price of the stock tends to be more volatile. So if you're looking to buy a stock at a low price and later sell it for a high price, you might find that common stock gives you a better increase in the stock price than preferred. Preferred stock, obviously, as we've discussed, you're more likely to get dividends. So a more conservative investor who doesn't really care about those capital gains from an increased stock price, they're looking more for dividends. They would be more likely to buy preferred stock. Okay, and then we learned about some of these different terms. In fact, I think this illustrates it nicely. First of all, stock has to be authorized. Again, who authorizes the company to sell stock? The state. Exactly. Whatever state they've incorporated in is who can authorize the stock. Then the stock that has been sold has been issued, right? So we see in this example, 1,500 shares have been issued, and there are 500 shares that have been authorized but were never issued. The company's waiting and they might sell those later. Of the 1,500 that have been issued, 100 were bought back as treasury stock, and so that leaves 1,400 shares outstanding. And why was it important to know how many shares are outstanding? When do we need that information? Really, two reasons why you might need to know how many shares are outstanding. Okay, one would be dividends, because you only pay dividends on the outstanding shares, not on the treasury stock. And the other would be to calculate your earnings per share. You take the earnings of the company, take out any dividends that are going to preferred stockholders, and then that amount you divide by the number of outstanding shares of common stock, and that is your earnings per share. Okay, we talked about how there's this concept of par value. What is par value? What is the relevance of that term in accounting? Okay, it's the face value of the stock. It's the value that's listed in the company's accounting records as the value of the stock. And it's an arbitrary amount. You just pick something, could be as low as a penny, could be as high as $100. More likely, let's say it's $1. And so they in their books, they just list every share as having a value of $1. But we know that that's not necessarily the market price. Can the market price for that stock be more than $1? Yeah. Could it be less than $1? Yeah, that's possible too. Because the market price is whatever investors are willing to pay for it, right? Which means that supply and demand impact the market price, investor perceptions, and other factors all influence the market price. So the par value is really for bookkeeping purposes. In some cases, the state does not require a par value and a company will use a stated value. And then, as I mentioned on Monday, we just treat that the same as par value. And then there might be other cases where the company does not use a par value or a stated value. So here was an example. This company, well, let's look at their common stock, because last time we looked at the preferred stock. So they have a 25-cent par value for their common stock. And so we would take the number of shares that are outstanding. Is that right? I think so. I'll double check the math. The number of shares outstanding times the par value. Notice that the number of shares outstanding is different from the number of shares that are issued. So quick math check, make sure I'm telling you the truth here. Calculator, 78,170 times 25%. 25 cents. Okay, and it's not that. So it must be this one. Let's total issued. Oh, wait. Shoot. Did it wrong. Okay, 78,441 times 25 cents. Oh, that also doesn't work out. Interesting. Let me see if I'm reading this wrong. This is issued, oh, it should be this one. The number of shares issued as of, oh, it's 2017. It should be that one. Okay, let's think this through. With the preferred stock, clearly, it's this 19,250 shares times the 1 cent par value. That is the value of the stock, right? So it's the shares issued, not outstanding. Okay, so it is issued. Now let's look here. Here we've got 2 years for common stock. We see this is issued shares for 2017, and this is for 2016. I think. Doesn't, oh yeah, 2017 is first, and then 2016. So this number, this is our issued shares for 2017. This should be it. Let's check. 175,000. Third time's a charm, right? 175,000 times 25 cent par value. That also doesn't work. Okay, let's do it this way. I'm going to take this number, 19,883, divide it by 25 cents. We get 79,532. Interesting. Fourth time is a charm in this case. So the way we would understand this, for the common stock, which has a 25 cent par value, we multiply it by this number. But we know this is issued. According to this, this would be 2016. I think that must be a typo, because this is 2017, right? So, okay. So anyways, you take the number of shares issued, sorry, it took me a while to get there, times the par value, and that is your value of your stock. If you received anything above that from your investors, that's what we call additional paid-in capital, right? And I'm gonna have to come back to this slide, because I think that is a typo. So let me just make myself a note. This is Stockholder Frontier Communications slide. Okay. I will have to fix that for next semester. All right. So again, this is how we journalize it. If we issued stock and got cash from the investors, we debit cash, credit common stock, and additional paid-in capital for anything we received above the par value. In this case, we got some services instead of cash, right? So we just debit the services. See what else do we need to cover. So here, this is, okay, if the company does not use a par value or stated value, then there's no additional paid-in capital. Whatever you got paid for the stock, you would debit to cash and credit to common stock. Nice and simple. Same thing for preferred stock, works the same way. Okay, so here is a statement of stockholders' equity. We see how much is the par value of the common stock, preferred stock, excuse me, plus the additional paid-in capital. How much is the par value of the common stock, plus the additional paid-in capital. If there were treasury stock, we would then subtract that amount. In fact, here we see an example of that, right? So the treasury stock, again, has been bought back by the company. So that reduces the overall stockholders' equity. That's how you journalize the purchase of treasury stock. We did that several times, so that was fairly easy. However, remember that when you sell treasury stock, you journalize the cost of that stock that you sold. So in this case, the company got $2,800. The cost of the treasury stock that they just sold was $2,500. Right? The price they charged to the stockholder was $2,800. The cost to the company was $2,500. So that difference is additional paid-in capital. And now, how would this journal entry look different if they sold the treasury stock for less than they paid for it? It would still be debiting cash. It would still be crediting treasury stock. But this additional paid in capital would be debited instead of credited. And I think we have an example of that somewhere. Oh, I'm going the wrong way. I was going backwards. Yeah, so here's an example where they got $2,300, but the treasury stock cost them $2,500. Right, so they're selling it at a loss, and that would be a debit to additional paid in capital. So let me make sure I didn't skip anything important. No, we covered that. We did that exercise. Are there any questions? Talked about that. Any questions? Oh, that's exactly where we left off. Okay, so the last thing we talked about was this. When the board of directors declares a dividend, you journalize that, but you don't pay the dividend right away. There's a second date called the date of record. Who remembers what's the significance of the date of record? What happens on that date? Okay, so that date is when, if you own the stock on that date, you will get the dividend. So whoever is on record as owning the stock will get the dividend, right? So if you sell the stock the next day, doesn't matter. You are already the stockholder on the date of record. Even though you've sold it, you're still going to get the dividend. Now, the next time, 3 months later, if the board pays out dividends again, you're no longer the owner of the stock, right? So on the next date of record, you won't get it. And then the third date is the date where the dividend's actually paid out. Which of these dates do we journalize? Do we journalize the declaration date? We do. We don't journalize the date of record, and we do journalize the date of payment. So the date of record is the only one we do not journalize because there's no financial transaction on that date. It's just a date where somebody takes a look at who owns the stock and says, okay, those are the people that we have to pay dividends to, but there's no actual transaction happening. Okay, now dividends are typically paid in cash because that's what investors really are looking for, right? There are other options though. You could pay dividends with property and you can pay dividends with more stock. So we will get to that, but because it's more common, we'll start with dividends, with cash dividends. So I think we talked about a scenario where a company was low on cash and how if you're not making profits and you're not flush with cash, maybe you should not be paying dividends, right? Or if a company just plans to grow, that might be another reason to not pay dividends. If you'd rather hold on to that money, retain more of those earnings so that you can fund your growth, that could be another reason to not pay dividends. Okay, here's what the date of declaration looks like. It's a debit to retained earnings and a credit to cash dividends payable. Let's think this through. Why is it when the board of directors declares that they're going to pay dividends, why would we debit retained earnings?
Because you're gonna have to pay those out at some point.
Yes, exactly. Remember that the dividends are getting paid out of the profits of the company. It's reducing the company's retained earnings, it's profits. And why would we credit cash dividends payable on the date we declare that we're going to pay dividends?
It's a liability.
Liability, right? We've stated that we're going to make this payment, but we haven't made the payment. So it's payable. Okay, that makes sense. Then when we pay it out, we debit cash dividends payable for the same amount, and we pay out the dividends. So we credit cash. And then again, on the date of record, there was no entry. So let's see, what are we doing here? What journal entries do we need to record these dividends? Okay. So we've got a $1 per share cash dividend. We have 4,000 shares of common stock that have been authorized, but that doesn't matter, right? We only pay dividends on the outstanding stock. There are 2,800 shares that have been issued, 400 shares in treasury. What would be the amount of the dividends that we would be paying out? $1 par value, right? Oh, 20-cent par value? Oh, it's a $1 dividend. Yeah, my bad. It's a $1 dividend, 2,800 shares issued, 400 shares are treasury stock. How much is our dividend?
Is it 800? Or is it 2,800?
Not either. How many shares are outstanding? We'll start there. Okay, 2,400 shares outstanding. How did you get that, Sergio?
2,800 were issued. 400 were back.
Okay, so the issued shares minus the treasury stock, right? Gives us 2,400 shares outstanding. And then we just multiply that by the $1 dividend that they declared. So it'd be $2,400 worth of dividends. On the date of declaration, it would look like this. Debit to retained earnings, credit to cash dividends payable. And then on the date of payment, it would look like this, right? Just like we saw on the last slide. Okay. We did this one already. Property dividends. So let's say the company has been profitable and they think we should reward our investors, we should give them a dividend, but we're kind of short on cash. Instead of giving them cash, let's give them some property. We'll send free product, right? We've got plenty of inventory. Let's send them pairs of shoes or whatever it is that we produce. Now, some investors might be happy to get that product. No, they don't have to pay sales tax on it. They're just getting it as a dividend. I wouldn't think. Well, would you have to pay income tax on it? That'd be an interesting question to ask a tax accountant. But in general, I'd say most investors don't want to really receive just property from their investments. They'd rather get cash, right? But if they are getting this property, notice that the journal entry is sort of similar to what we saw for cash dividends, right? It's a debit to retained earnings. And then instead of cash dividends payable, property dividends payable. Then when they pay it out, it's a debit to property dividends payable, and they're sending inventory. So it's a credit to inventory. Okay. Then we get to stock dividends. So maybe our board of directors wants to pay out some dividends, and they decide we're going to do that with stock. So we're just going to give our investors more stock. How would you feel about that as an investor? Let's say you own 100 shares of stock in the company, and they give you an extra 5 shares. Does that have any immediate monetary value to you? Think about it this way. Sure, now you have 105 shares, right? But everybody got an extra 5% more shares. So it's kind of like you took the same pie and just sliced it in smaller pieces, right? Maybe you owned 6% of the company before, you still own 6% of the company. It's just that 6% is cut up a little bit more narrowly. So immediately, there really is no direct benefit to you. But the hope is that in the future, more people will buy the company stock. And they're not going to get that 5%. They have to buy each share individually. So you then benefited. And when dividends are paid out in the future, you're going to get dividends for 105 shares, not for 100 shares. And when you go to sell your stock, you can sell 105. So it probably would benefit you over time, but immediately it doesn't provide any direct monetary value. As it says here, with a stock dividend, or at least a small stock dividend, and we'll talk about the difference here in a moment, there's no change in total assets, total liabilities, or stockholders' equity. So they're not increasing any part of the accounting equation. Like I said, they're just cutting up the equity pie into smaller pieces. Okay, so there's what's called a small stock dividend, and there's what's called a large stock dividend. The difference is how much of the company's stock is being given out. If the company is giving out an amount equal to or less than 25% of the outstanding shares, it's considered a small stock dividend. If it's more than 25%, it's considered a large stock dividend. Okay, so that's a threshold. 25% of the existing outstanding shares. And the reason we treat it differently is if you're giving out so much stock that it's more than 25% of your outstanding shares, that's enough, it could sway the stock price. Investors would take notice and they might buy or sell the stock because of that, which could impact the stock price. But if you're giving out less than 25% in your stock dividend, that's less likely to happen. So the way we process it is very different. We will also get to stock splits, but we will wait on that. I don't want to get ahead of myself. Okay, so here, small stock dividend. This company has 60,000 shares that have been issued and are outstanding. All right. And they've decided to issue a 5% stock dividend. All right, so what we do, we take those 60,000 shares times 5% times the par value of 50 cents, and that is the value of the common stock we're going to be giving out to our investors. So it's the number of shares outstanding times the percentage dividend that was declared times the par value. So here the company is giving out 1,500 shares of stock. What you have to do then is multiply that by the market price. So again, the company has 60,000 shares outstanding. They're giving out 5% more. And if the market price of the stock is $9 per share, that means they're giving out $27,000 worth of stock from the market perspective. And that's how much they have to reduce their retained earnings. And so the difference would be additional paid in capital. Okay. Then, oh, and by the way, notice that this credit here is not to common stock, but it's to common stock dividend distributable. I think that's the only time you'll see that particular account in this whole semester. Then when the payment date comes around, that common stock dividend distributable gets debited and you actually issue the common stock. Okay, so that's how you would journalize a small stock dividend. Any questions, any comments? All right, let's look at the impact on the equity section of the balance sheet. Remember, initially there was $30,000 worth of stock here that had been issued. And now we issued $1,500 more, right? So we get this total. There was $44,000 in additional paid in capital before the small stock dividend. We increased that right here by $25,500. So this is our new additional paid in capital. And then retained earnings, remember, went down because that's how you fund this dividend, right? So we have the previous retained earnings minus the reduction, giving us our retained earnings after the dividend. But notice the total equity did not change. It stayed at 125,000. So it's just shuffling things around within the equity, right? It does not increase or decrease equity. Okay, questions or comments? Question? All right, so a large stock dividend. If it's more than 25% of the outstanding shares that are being paid out as a dividend, we handle it differently. All right, let's see how we handle it here. Debit retained earnings, credit common stock dividends distributable. The way they calculate the amount, the number of outstanding shares times it's 30%. That's the percentage that the board of directors declared. They're going to pay a 30% stock dividend. So the number of shares times the percentage that was declared times the par value. How does this journal entry for the large stock dividend differ from the journal entry for the small stock dividend? They both have a debit to retained earnings. They both have common stock dividends distributable. What's missing though, when we compare it with the small stock dividend journal entry? There's no additional paid in capital, right? So when you're doing a large stock dividend, there's no impact on additional paid in capital. You take it out of retained earnings. On the payment date, you debit that common stock dividends distributable and you issue the stock. So here, let's see the before and after. Before the dividend, we had $30,000 of common stock. $9,000 was the impact. Again, that's calculated by the number of shares outstanding times the percentage times the par value. So that means we have $39,000 of common stock after the dividend. No change to additional paid in capital, and retained earnings went down by $9,000. Again, the total equity did not change, right? And additional paid in capital did not change. Okay, so in the first scenario with the small stock dividend, common stock went up only by $1,500. right? And retained earnings went down by 27,000. So interestingly, in the large stock dividend, retained earnings did not decrease as much. There was a bigger impact from paying a small stock dividend than a large stock dividend. But again, the reason it's different is because if we do pay out a large stock dividend, the expectation is it's going to have a bigger impact on the market price of the stock. So this is the way you do it. Any questions here on large stock dividends? Okay. All right, stock splits. A stock split has some similarities to stock dividends, but differences, obviously. Basically, what you do with the stock split is, again, you're not creating extra value immediately for your investors. You are just cutting up the pie differently, but it's with a specific purpose. The reason you would do a stock split would typically be because you want to bring the price of your stock down. Let's say that your company's been pretty successful, the stock price has gone up. Maybe it went up from $100 last year to $1,000 this year. And so there are a lot of investors that would like to buy your stock, but they look at the price of the stock and they think, oh, that's pretty pricey. I don't think I want to spend $1,000 just for one share. So then what you can do is a stock split. For example, if you do a 2-for-1 split, you bring the price down in half. Now your stock is only $500 per share, and you get more investors purchasing. But you all know that typically companies want their stock price to go up, right? So this would only happen if there's so much demand for your stock that you need to cool it down a little bit. And then the hope is once you drop the price down to $500, it's going to start going back up again. Now, imagine you own one share of stock in this particular company. And they tell you, we're doing a stock split. Your $1,000 stock is now going to be worth $500. You would not be happy about that, right? So what they do is say, because the price is going to drop in half, you're going to have twice as many shares. So now you have 2 shares, each worth $500. You don't lose anything. You don't gain anything. But if the plan is successful and it causes more investors to buy the stock and it pushes the stock price up, you now have 2 shares benefiting from an increase in stock price. So if it works, and it doesn't always work, but if it does work, you make more money. Not immediately, but over time. So let's see, any questions so far? All right. As it says here, when a split occurs, the market value is reduced. Now I added this in. I don't think the textbook talks about reverse splits. A reverse split would be the opposite. If you do a reverse split, you're causing the price of the stock to go up and you're reducing the number of shares people have. So again, it's a wash for each individual investor. You would do that if your stock price was so low that people looked at it as not a very valuable company. So you could do a reverse split and get your stock price to go up. Again, might or might not work because so much of investing depends on investor perception, right? There's no telling what investors are actually going to do, but that would be the idea behind a reverse split. Especially because if your stock gets too low in price, you might get kicked off of a stock exchange. If it gets to what's considered a penny stock, where it's like $5 a share or less, I've actually seen this happen. The stock exchange will say, we don't want you on our stock exchange anymore. We don't like penny stocks. Now, if somebody wants to buy your stock, they have to buy it over the counter, not over a stock exchange. Now, as it says here, there's no journal entry for a stock split. Because again, there is no financial transaction. You're simply saying, we're changing the par value of this stock, which changes the market value, and we are changing the number of shares. So it would get recorded somewhere, but not in the journal. So here's an example. In this case, it's a 4-for-1 split. So if you had 1 share, you're now going to have 4, but each share would be worth 1/4 as much, right? So initially there were 60,000 shares, each worth 50 cents. Now that's a pretty low. Oh, I'm sorry, that's the par value, not the market value. If that were the market value, that would be really bad. It's the par value. So there's 60 shares with the 50-cent par value. Total is $30,000. Total par value of all the stock. After the split, there are 4 times as many shares, so 240,000 shares. The par value is now 12.5 cents per share, so 1/4 as much, and it equals the same 30,000. So again, we're just slicing the pie up differently. Okay, questions? Okay, let's see the impact of the equity section here before and after the stock split. Interesting, no change. There was $30,000 of common stock, there's still $30,000 of common stock. No change to additional paid-in capital, no change to retained earnings, no change to equity. The only change was a note somewhere in our accounting records that says we made this change. Of course, it would be communicated to the investors, but it does not directly impact our financials. Okay, what if we are doing a 3-for-2 stock split? Okay, now the math is getting a little more challenging. 3-for-2. What would be the accounting entries necessary to recognize the split? Well, no journal entries are needed, but we would just need to make a record of it, right? What effect is the split going to have on the balance sheet? Well, the only impact, and there's no change to assets, liabilities, or equity, but where there were 100 shares, each worth $6, what we would do, take that 100 shares, multiply by 3, divide by 2. So for every 2 shares somebody had, they now have 3 shares. Okay. Or you could think of it as now they have 50% more. So 100 shares times 3 divided by 2 gives us 150. And then the par value of $6, we would say $6 times 2 divided by 3. You have to do it the other way around. We bring the value down to 4. Or you could say 2/3. So it gets a little tricky when you start to think about the math for a weird split like 3-for-2. But you won't have to do a whole lot of that on the problem set. Any questions here? Okay. Let's see, prepare the journal entries for these transactions and provide the balance in the following accounts. Okay, this is a good exercise for us to work through together here. So let's go ahead, I'll just go over to the computer and we'll go through this step by step. I'll put this in a Word document. Give us a little more room to document things here. Right. And that's taking up a lot of space. Let's see if I can. There we go. That's better. Okay, perfect. All right, let's work through this. So the company in the first year of operations had a net profit of $16,000. There are 100 shares of $1 par value common stock issued for $32 per share. Okay, we're going to have to journalize that transaction. Then the company buys back 10 shares at $35 a share, and they pay a dividend of $1.50. Okay, so I'm assuming we already declared the dividend previously, because it doesn't say anything about the declaration of the dividend. And let's go ahead and we'll do these 3 journal entries, and then we'll figure out what is the balance in each of these accounts. So the first journal entry, we issue 100 shares of stock at $1 par value and a price of $32 per share. What would we debit? When we sell the stock for cash, what would we debit?
All good shares.
It would be 100 shares. That's true. What account would we debit when we sell the stock for cash? Cash. Okay. Cash. And it is 100 shares. So how much cash would we be receiving? 3,200. Very good, Jackie. Okay. Great. What are we going to credit in this transaction?
Common stock.
Common stock is right. Okay. Credit common stock for how much? Actually not, because there's a par value, right? If there was no par value or stated value, then it would be 3,200. But when there's a par value, we do it differently. It's 100. 100 shares times the $1 par value. Great. And then what else would we credit?
Additional paid in capital.
You got it. Additional paid in capital. Okay, I'm running out of room there. And that would be the remaining 3,100, right? Okay, great. That's our first transaction. Then the company buys 10 shares at $35 each. What would we debit? Company bought stock back from the investor. We would credit cash. But what do we debit?
Treasury stock.
Treasury stock. Very good. Okay. And the amount would be what? $350. 10 shares at $35 each. Okay, perfect. Next transaction, we pay a cash dividend of $1.50 per share. All right. Does anybody remember what account we use when we pay out the cash dividends? Well, when we declare the dividend, we would debit retained earnings. But in this case, we're just paying out the dividends, so we are assuming we already declared them previously. So we would debit cash dividends distributable, right? I think that's what it was called. It might be payable. Let's check. I don't have the best track record for accuracy today, so let's make sure. Let's see. Yeah, it should be cash dividends payable. You're right. Cash dividends payable. Perfect. Okay. And what would we credit when? Oh, actually, the amount. Oh, the amount. What would the amount be? How do we figure out the amount of the dividend? It says it's $1.50 per share, but how many shares are we talking about? 90. Good job. That's right. There were 100 shares that we issued. We bought back 10. So we would only be paying dividends on the 90 outstanding shares, right? We multiply that by $1.50. Pretty sure that comes to $135, right? Yeah. Okay, good. All right. So we debit cash dividends payable. What would we credit? Cash. Nice. Okay. Okay, so those are our 3 journal entries. Now we need to figure out what is the balance in each of the following accounts. Common stock. All right, well, it would be $100 because that's the only common stock transaction, right? Now, actually, this example here is kind of weird because, well, I guess, okay. We can assume here this is the only stock we've ever issued. Why did we declare dividends before we even issued any stock? That would be kind of weird, right? But okay, I think I'm overthinking it. Okay, so anyways, our balance in common stock would be a credit balance of $100 because that's the only common stock transaction. Since it's a new company, it's the only common stock transaction they've ever had. What is the balance in dividends? Well, we would have paid out $135 worth of dividends. Paid in capital, that's the only transaction, so there'd be a credit balance of $3,100. Retained earnings. Well, we can assume, like I said, that we did declare the, let's just go ahead and put it in there. Let's go ahead and put in the journal entry for declaring the dividends. It would be a debit to retained earnings of 135, and then a credit to cash dividends payable of 135. So our balance in retained earnings would be a debit of 135, which that's also kind of weird, actually, now that I think about it, because we haven't had any profits yet, right? We've got negative retained earnings. That's not good. What else? Let's see. Treasury stock. Well, we have only one treasury stock transaction, so the balance would be debit of 350. But let me ask you 2 more questions. What would be the balance in our cash dividends payable account? Was there 0? That's right. Right? Because we have 1 debit, 1 credit, both for the same amount. And the other question would be, what would be the balance in our cash account? Now, this is assuming we've had no other cash transactions. We have a debit to cash, 3,200, minus the 2 debits, right? The 350 and the 135. So that would give us our remaining debit balance. Just out of curiosity, let's see what it comes out to. 3,200 minus 350 minus 135. So we'd have a debit balance in the cash account of 2,750. Okay. Questions? Oops, wrong document. There we go. So let's see, we passed all that. Let me find where we were. Right there. Okay. So back to the PowerPoint. Okay, well, we know contributed capital is the money that the investors contributed to the company, right? And that's reflected in the stock and the additional paid-in capital that we received that was above the par value. And then earned capital would be the earnings, the retained earnings of the company that it has earned through its profits. So let's see, the retained earnings is the profits, the net income, minus any losses and minus any dividends. You know that already. Here we see a statement of retained earnings. So just to refresh your memory, you take your beginning retained earnings plus any net income minus any dividends, and you get your ending retained earnings, right? And if there were a loss, we would subtract that loss instead of adding the net income. Okay, it's possible for there to be restricted retained earnings. There might be some retained earnings where the state has set some kind of restriction on the company, so that well, I can't paraphrase it, I can only read it, so that the legal capital of the stock does not drop below zero. So you're saying you have to keep a certain retained earnings so that your treasury stock and your retained earnings, have to stay within certain limits. There might also be restrictions to retained earnings based on an agreement that the company has with a lender, where the lender says, okay, we will make a loan to you, but you need to keep a certain amount of profit in your retained earnings. Otherwise, we're going to raise your interest rate, or we're going to call the loan and you have to pay us back. And they do that because they want to make sure the company doesn't just blow all of its profits, like give them away in dividends, or if the company has losses after losses, ends up with no profit anymore that they've retained, there's a better chance that the company will go out of business and the bank never gets their money back. So both the state and a lender can require certain restrictions on the retained earnings. Companies can appropriate retained earnings, saying that we've got certain retained earnings that we have set aside for a certain amount. We've appropriated this portion of our retained earnings for this special project, for example, or building a new office, whatever it might be. So the journal entry in that case would be you take some of your unappropriated retained earnings and you create a new account for appropriated retained earnings. It's kind of like with petty cash. You're just taking money out of the bank and you're putting it in the petty cash drawer. Here we're saying, okay, here's some of our profits. We're going to set a certain amount aside and appropriate it for a specific purpose. So that's the journal entry. It does say here, another option instead of the journal entry would be just disclose it in your financial statement. That's one of the rare areas, financial accounting, where you have discretion. You have a choice. GAAP gives you the option of doing it either way. All right, let's see. Okay, here we see a statement of stockholders' equity. And it's showing how things have changed throughout this year. When you're working on your course projects, remember one of the things you're going to have to do is get the last 4 sets of financial statements for the last 4 years for the company, including their statements of stockholders' equity. We've not spent a lot of time on those statements. They're not super complicated, but this will help give you, a better understanding of how to read them. So here we're saying for this company, at the beginning of the year, there was $5,000 of common stock that they had issued. Then they issued another 800 shares at $1 par value. And so by the end of the year, they have an ending balance of $5,800 of common stock that was issued. Okay. You just read it from top to bottom. They had 64,000 in additional paid in capital at the beginning of the year. Then when they issued these 800 shares of common stock, that increased the paid in capital by $3,600. Okay, so I'm going to challenge your minds here for a second, put your brain to work. What was the price of the stock when they issued these 800 shares? If there was $3,600 of additional paid in value, paid in capital, excuse me, what was the stock price?
$6. $5.50.
Well, let's see. Let me do some mental math here and answer my own question. If we take the amount here from common stock, which is based on the par value, and we take the amount that was in excess of the par value, together that's $4,400, right? We would then divide that by the 800 shares. What does that come out to? 550. Okay, you got it right. There you go. With treasury stock, at the beginning of the year, there was $1,200 worth of treasury stock that had cost the company $3 a share. So simple math, that's 400 shares, right? 1,200 divided by $3 would be 400 shares. Now, why is that in parentheses? Who can tell me? Why would the treasury stock be in parentheses? Negative. It's decreasing the equity, right? Because when you buy back that treasury stock, the stockholders have less equity. It got transferred back to the company. Okay. Now down here, you see that there's another 600 shares of treasury stock at $4,200. So what was the price that the company paid when they bought back that stock per share? $4,200 worth of stock, 600 shares. I think it's $7 a share, right? If you divide 4,200 by 6, it comes out to 4,200. We're close. Anybody have an exact 4,200 divided by 600? 107? Yeah, $7 a share. Okay, so there was $1,200 of treasury stock plus another 42 means now there's $5,400 worth of treasury stock. All right. You see retained earnings was here. The company had some net income, paid out some dividends, or at least declared dividends. And that's the ending balance in retained earnings. And then we just have a total for every row. Okay. Not that hard to read. Just kind of have to take it a step at a time. Any questions on that statement? Okay. So actually, when you do your course project, and you're going to be looking at 4 years of statements of stockholders' equity, and you'll just be looking for how things have changed, right? Did the company buy back a lot of its stock? Did they issue a lot more stock? And was it common or was it preferred? These are the sorts of things you'll be looking at to try to evaluate, the overall financial performance of the company. Okay, as we know, mistakes happen in accounting, right? due to mathematical errors, misinterpretation of GAAP. Sometimes GAAP might be complicated, or somebody might just, make a mistake in how they remember GAAP. And so they record something wrong. Or a misunderstanding of the facts. You thought there was $10,000 of inventory and there was $12,000 of inventory, right? So all of these things can impact the accuracy of the financial statements. So then we have to go in and we have to make corrections. Those corrections can impact the balance sheet and the income statement. I think we've seen examples of that, right, in recent weeks, where there was a mistake and we saw how it impacted multiple financial statements. Okay, so what you could do then, if you found that in last year's financial statement there was a mistake, well, you're now going to have to correct it, right? It's going to throw off your beginning retained earnings. If it had anything to do with your profits, then you're going to have to make that correction and have your corrected retained earnings or your beginning retained earnings amount. So here's an example. There was an understatement of depreciation. So they should have counted an extra $1,000 of depreciation expense, and they didn't, right? So how do we fix that? Well, increasing the expense would decrease the profits, right? Which means retained earnings would go down. We know retained earnings increases on the credit side, decreases on the debit side, right? And accumulated depreciation would go up because there was an extra $1,000 of depreciation. We've done this one. We can skip number 17. Here's a statement of retained earnings. Let's see what's going on here. Oh yes, the impact of income taxes. So in that case where there was a $1,000 error, we see our profits went down by 1,000. But remember, less profit means less income tax. So if our profits have gone down by $1,000, the net impact, if we're in a 30% tax bracket, is only $700. So how do we figure that out? Well, we could take that $1,000 mistake. If we're in a 30% tax bracket, that means it's going to save us $300 on income tax. Or kind of an easier way to think about it, maybe. For me, it's like this would be one way to think about it. You take the adjustment of $1,000, multiply by the tax rate, that gives you $300. You then subtract it from the error, and then the net impact is $700. To me, that's the harder way to think about it. The easier way is if you're in a 30% tax bracket, you're keeping 70% of your profits. So if your profits are going down by $1,000, you just multiply that by 70%. Your profits are really going down by 70% of $1,000 or $700. So either way, so now they are making that adjustment to their retained earnings net of income tax. So they're only adjusting it by the $700 net impact. Okay, before we get to earnings per share, any questions, comments? So I've mentioned earnings per share, I'm sure. It is a very common ratio among investors and stock analysts. And it's not that difficult to calculate. It is one of the financial ratios that you should be including in your analysis on your course project. As it says here, some analysts think it is the single most important tool in assessing a stock market's price. A high or an increasing earnings per share can drive up a stock price. So it's not just me saying it. Textbook says it too. There is another very common ratio that is used in investing, the price earnings ratio. often just referred to as the PE ratio. That ratio requires the EPS because the price earnings ratio is the price of the stock divided by the earnings per share. So you can't calculate the PE ratio until you have calculated the earnings per share. Here is the formula. I think I mentioned it earlier today. To get your EPS, it's the net income of the company minus whatever dividends are going to be paid or have been paid to the preferred stockholders. And the reason for that is this is really a metric that relates to the common stock. And the common stockholders don't care about the dividends going to the preferred stockholders. So really what it's saying is how much profit does the company have from this period minus whatever it's going to pay to those preferred stockholders that we don't care about if we're common stockholders. But then you divide that by the weighted average common shares outstanding. Okay, that's a new thing for us. Fortunately, it's not that difficult to calculate. I'll show you how we do that right here. So here's a company that at the beginning of the year had 600 shares that had been issued. Okay, 600 shares of common stock. Then on April 1st, they issue another 1,600 shares. No, I'm sorry, they issue another 1,000 shares. So now they went from 600 on January 1st to 1,600 on April 1st. Okay. And those were the only changes in the stock that this company issued that year. Now that's unusual, right? But just for simplicity's sake, we have only two amounts, 600 at the beginning of the year, 1,600 from April on. So what we would do is take the 600 shares that we started with for 3 months, January, February, March. So we multiply by 3 and divide by 12. Then we take the 1,600 shares that had been issued from April 1st through December, right? And this is counting the previously issued shares. April through December is 9 months. So we multiply by 9, divide by 12. Then we take those two results, we add them together. That is the weighted average common shares outstanding. Okay, so even though there was, for the first 3 months of the year, there were 600 shares outstanding, and then for the rest of the year there were 1,600. When we average it out this way, it comes out to 1,350. That's our weighted average shares. That would be the denominator in this calculation here. Okay. So we take the company's net income minus the preferred dividends divided by the weighted average shares. That's our earnings per share. Okay, questions? All right, now let's look at the impact of buying back your own stock. For this company, we see the numerator is $15,000. The weighted average shares is 20,000, and they have a $75,000 EPS. But then if they bought back some of their own shares, they would have fewer shares, right, that are outstanding. What happens to the EPS? It goes up. I think I've mentioned companies in recent years have been buying back their own stock because they had extra cash. That pushes up the stock price, and this is how it happens, right? There's less stock out there, the earnings per share goes up, and then just supply and demand. Consumers are, the investors are willing to pay more because there are fewer shares available. So that also pushes up the price. Okay, so the impact of buying back your own stock is it increases your EPS and your stock price. If you sell treasury stock, then the opposite would be true, right? Then your EPS would go down. So what are ethical considerations involved in calculating EPS? It used to be, from what I understand, it was before my time, it used to be illegal for companies to buy back their own stock because that was considered stock manipulation. You're artificially changing the price of your stock. For some reason, that was changed. It's now legal. Now you've got executives buying, authorizing the company to buy back shares so that they have these huge bonuses because they get compensated mostly on stock price. And an ethical issue? I think so, right? Because the average investor does not have that ability to make that decision. They might, in some cases, benefit, but they might be harmed by that decision. And most Americans are not investors at all, right? So who benefits? The executives and the investors with the most money that can influence these decisions benefit. So yeah, I would say that there's an ethical consideration. I might have mentioned this, but there is a difference here. Notice on this, what is this we're looking at? An income statement. By the way, when you're doing your course project and you're looking at the financial statements of companies, you might often see that their financial statements say something like this: consolidated statements of income. It's an income statement. By consolidated, what it probably means is this company has multiple subsidiaries that they own, and this is like all of their combined profits. Like Alphabet, Google's parent company, has many subsidiaries. YouTube, Google, Waymo, those would all be part of Alphabet. So my guess is if you looked at their financial statements and it says consolidated income statement, it's the income statement for all of their companies combined. But down here we see the net income per share. We see basic and diluted. And you'll see the same thing with earnings per share. Basic versus diluted. So do you remember when we learned about bonds and we learned that there are convertible bonds that you could convert into stock? Right? That's really what we're talking about here. If all of the convertible bonds converted into stock, then you would have this diluted amount. So that's the difference between basic and diluted. The basic is what it is right now. Diluted is if all the convertible securities converted into stock. And it doesn't really matter if you are, there's a problem that you're going to do where you have to look up earnings per share for two different companies. Also, when you're doing your analysis for your course project, I don't care if you use the diluted or undiluted amount, either one's fine. They're usually not that different anyways. So we do need to do that exercise. Let me see what else we have to cover here. We do have a few more slides. You know what, let's just go ahead and let's just wrap it up, and we're going to do that exercise anyway. So let's just keep going, not stop at this point for that exercise. Okay, what if in 1997, okay, that would be what, 27 years ago? So you might not have been born yet. Or maybe you were, but if in 1997 you invested $5,000 just one time in Amazon, just one purchase of Amazon stock, $5,000, it would be worth nearly $1 million. And this is as of about 2017. So this is over about a 20-year period. That's a pretty good return on that investment, right? $5,000 in 20 years grows to $1 million. However, would you have invested? If you had that 5,000 and you were looking to buy stock and you looked at Amazon specifically, you would have seen a negative earnings per share of 11 cents. They had a loss of 11 cents per share of stock for that most recent year. That wouldn't look like the greatest investment, right? Unless you were a savvy enough investor to see that the company was growing very rapidly, that the reason they were operating at a loss was because they were piling so much money into their rapid growth. And if you could see that this was going to become the e-commerce juggernaut that it became, then it would have been a no-brainer, right? But we never know. So this illustrates earnings per share is a useful metric, but it doesn't tell you the whole picture, right? And then that's true of all the financial ratios. Each one tells us something, but they don't give us the whole picture. Okay, you were awarded 10 shares of stock in your employer's company. Great. How could you use earnings per share to help you decide whether to sell the stock or keep it for the future? So let's just use the last example. Let's say it's 1997 and you're working for Amazon, and Jeff Bezos says to you, "You're doing a great job. Here are 10 shares of Amazon stock." And you say, "Okay, the company is losing 11 cents per share. Should I be excited about this?" Right? But again, that doesn't tell you the whole picture. If your boss gives you 10 shares of stock and the company's got a $10 earnings per share or $50 earnings per share, that looks a lot more promising, right? You don't know, again, is it sustainable? You look what happened to Twitter. You know, they were a pretty profitable company, and then Elon Musk came in and messed with it and took them private. And knows what's going on, but I don't think I would, even if it were publicly traded again, I don't know that I'd want to invest in that company. So sometimes companies that are very profitable run into problems, right? Sometimes companies that are losing money are good investments. There's no black and white answer. If we knew, right? If you could just crunch the numbers and know exactly what stock to pick, everybody would do it, right? And in fact, people would use algorithms to just decide what stocks to buy. But it's not so simple, crunching the numbers. Because there is psychology involved, and there is, in some cases, corruption, in some cases, greed. All these things influence whether or not a company is really going to be a good investment over time. But still, the financial ratios are useful, right, in understanding what's happening with the company. Okay, so we've learned a lot, and it's kind of a meaty chapter. Again, next week's chapter 15, is fairly easy on partnership accounting. What we'll probably do next week, we'll probably get through that chapter ahead of schedule, and we'll get a head start on chapter 16, because that next week is the last week of the semester, right? And that is a hard chapter, so I think if we can get a head start, you will appreciate that during the final week of class. Okay, so let's see, what did we learn about? Again, corporations, right? This is corporate accounting that we were learning about this chapter. And a corporation is a separate legal entity. It gives limited liability to the investors, meaning the most that they can lose is their investment. It's easy to transfer ownership from one investor to another by selling the stock. Corporations tend to just keep going on indefinitely, and it's easy for them to raise capital. There are costs to forming a corporation and ongoing costs to pay your filing fees and things like that. There is a lot of regulation over corporations, and there is double taxation if the corporation makes a profit and then pays out dividends, right? The common stock is the stock issued in exchange for money contributed from the investors. There are two basic types, common and preferred. Let's see, the stock has to first be authorized by the state. When it's sold, we say it's been issued, and the shares that have not been bought back are outstanding. There are 4 rights that the common stockholders have. They have the right to vote. They have the right to get dividends if there are any available after the preferred stockholders got the dividends. If the company gets liquidated and there's anything left over after everybody else got whatever was left over, the remainder goes to the common stockholders. And they also have the preemptive right to buy more stock when more stock is being issued to keep their share of ownership. Then we know treasury stock is when the company buys stock back. The board of directors can declare dividends and pay that out to the investors in the form of cash, property, or more stock. There are also stock splits, right, where you just change the par value of the stock and the number of shares that are outstanding, right? We talked about how to do that. Let's see, the retained earnings is the profit that the company has kept and has not paid out in dividends. We looked at the statement of stockholders' equity and how you track the beginning and ending balance of each of the different accounts. We talked about if there's a mistake that you have to correct, you can adjust your beginning retained earnings amount, but you also have to take into account what was the impact on taxes. We learned about earnings per share as one of the most common financial ratios and how to calculate it. Okay? So you survived. It's 2:33. We've got the 3 exercises and I think 4 problems to go through. So I have a feeling that a break is in order, even though it's not quite